Welcome to another podcast episode of From Worry to Wealth. We're part of the Wealth Creators Institute, and we're excited that you're with us. I am your host, Ben Lyons, and I am very, very excited once again to be with my business partner and co-host, Alex Fink. In this episode, we talk about the explosion of private credit over the last 20 years, along with a declining number of banks and credit unions. We've seen a tremendous decline, and we're going to be covering the details of why that happened. Why did private credit explode? And why did the number of banks decline? We'll get into a few more nuances as to the benefits of private credit and also the challenges with regulated banks. And with that, we'll see you in the podcast. Alex, here we are again, another podcast.
Very exciting stuff, Ben.
It is exciting. In today's podcast, title, The Growth of Private Credit, or the shrinking number of banks and the explosion or the rise in the private credit markets. That's a pretty cool topic, right?
Something near and dear to our hearts, Benjamin.
It sure is. So let's take this time and educate our listeners, viewers, on really what's happened the last 20 years, because I think it's about 20 years that we've seen this contraction of banks and credit unions and this explosion of private credit. But before we get into that, let's do a plug here.
Yeah.
On the book, Be the Bank, written in 2015. It's about private lending. You can get a copy on Amazon or contact us, and we'll send you a copy. Got to plug the book, right, Alex?
Yes, absolutely.
Yeah. So this is about private credit. It was written really at a time when didn't know that private credit was going to explode like it is. All right. So let me start us off by saying that when I started in my career in 1983, I know, a long time ago, there were 17,000 banks and credit unions in the United States. And I think you know the answer because we've talked about it. But today, 2025, how many banks in the United States?
Yeah, only a few thousand, right?
Yeah, I think the number's less than 4,000. I think the 3,700 banks. So we've seen this tremendous consolidation. So what's happened? Let's first educate our viewers and listeners on what's happened. I'll start us off by saying that the regulations in 2008, the introduction of Dodd-Frank, made it very costly, made it very difficult from a regulatory point of view for little teeny banks, the community bank, to justify the cost. So I think we saw this consolidation from the regulatory issues.
Yeah, for sure.
And what are some of the other reasons? And I cheated. I went on ChatGPT and looked at some of the other reasons. But
well, we don't even need to be here then. Right?
We'll test you. So
right.
So compliance was one. Let's see what some of the other reasons.
Well, I think scale is a challenge, right? And you think about recently some of the issues with banks being challenged with liquidity and capital drove a lot of the depositors, in my mind, this is a more recent event, right? Drove a lot of the depositors to think, I want to be with a larger bank that is too big to fail, right? Versus a regional bank versus a small bank. So I know there's some transient deposits that certainly affected a lot of the smaller banks. So that's one factor.
Yeah. The takeover of the money center banks and the centralization of decision-making. Remember, you're younger than me, but
yeah,
we used to drive to our local bank and meet with Bob.
Shake somebody's hand.
And say, hey, Bob, I need some help. I need to borrow some money. I want to do this. I want to do that.
Right.
And I think that's gone.
Yeah, it's really kind of sad, actually, in some ways. But
it is sad.
Yeah.
Now, the savings and loan crisis was really, I think, early in my career, that was probably one of the first things where the issues of the savings and loans, somewhat Wild West. I would say there were some people that took advantage of the system and cost a lot of money for taxpayers and shareholders of banks.
Yeah, and we've seen this consolidation in other industries, right? It's like, why don't we go to a local grocery store? Some places you do, right? Versus a Walmart, versus a Target, versus a Publix, right? So I think just the smaller guys competing, the cost of employees, the cost of insurance, the right level of acumen to handle the regulatory environment. If you have 1,000 branches versus 3, your corporate office can better manage the compliance aspects of it. And I think you get economies of scale. And that's probably true in a lot of industries, but it's certainly affected the banking industry as well.
Yes. And what were the unintended consequences of this consolidation where you couldn't walk in to see Bob anymore, shake his hand and say, "Hey, Bob, I need to borrow some money. I'm buying a property. Can you lend me some money?" What were the unintended consequences?
Well, there are a number, but certainly the knowing your client, right, has kind of gone away. And you're now, as you apply for a loan, you're a list of check boxes, right, where you have a much more narrow credit window, in my belief, right, that you have to fit within. That makes it challenging for some of the small businesses to get financing, or some individuals to buy an investment property or do things like that.
You've become a credit score, Alex. You no longer have a name.
Right,
It's
exactly.
what's your score,
Yeah, exactly.
right?
Right. Yeah, for sure, for sure.
We don't even know your name.
Yeah. And you see that. What's interesting is you see that not only in terms of lending, but you see it in terms of, can I even open a business bank account, right? We've even had situations where some of our companies, you apply to a bank online to open a business account, and they just automatically deny you because your tax classification is outside of what their regulatory approval is, and they just say, nope, no business bank account. That never happened, 20, 30 years ago.
It didn't. And I think the frustration by small business owners and by by real estate people like us,
Right.
people who like to borrow money on real estate. We talk about leverage like ad nauseum in
Yeah,
our
for sure.
courses, and that's borrowing money. And now there's no longer this relationship.
Yeah, and that relationship affects things like speed to the decision, right? So you have many, consumers and businesses that apply for a loan that go through this process for a series of months. And as a result, those business owners or those consumers are very, very nervous if they're under contract to buy a house, or if they have some impending situation in their business come up, and they need to know that they're going to have money available on a date certain. I think that's really challenging in today's environment with the large banks.
Yeah. So the
So that's an
solution.
unintended consequence as well.
So the
Yeah.
solution is
Private credit.
right. So for our audience, let's describe or give them the definitional, really, argument of what a private credit is. You
Yeah.
want to go?
Yeah, non-bank lenders, right?
Right. Non-regulated,
Yeah.
effectively non-bank lenders. So
Yeah.
what would they be? They'd be private investors,
Mhm.
private equity funds,
Mhm.
hedge funds.
Right.
And the growth is now, you can read the numbers. I think it's now over $1 trillion. Some say it's pushing $2 trillion market,
Right.
which is nuts.
Yeah, it is. It is nuts. It's insane.
And, I just want to kind of digress for a little bit that as an 18-year-old who went to work for a private lender, when the guy and all the people I were surrounded by that lent money in the 1980s, they were like, private credit is the shit because lending money as an investment is the greatest thing on the
Right.
planet.
Yeah.
But yet, if I ever talk to anybody about that, everybody say, well, nobody does that. What do you mean?
Right. Yeah.
I said, what do you mean nobody does that?
Right.
Everybody does that.
Right,
They're
right.
like, no, nobody does that. Just the banks.
Right.
And now all of a sudden, everybody's doing it.
Right. Well, imagine, if it was good for the banks, it's probably good for everybody. If the banks could have a better way of doing things, they would do it.
Yeah.
They need to make money, and they do it through lending.
So private credit has exploded. And, let's talk about why private credit over a bank. Why borrow from a private individual or private equity fund or a private lender or a non-bank? Let's cover.
Yeah, one is
every-
just speed.
speed.
Right.
Speed is
Speed's a
probably
huge-
the number one thing.
Yeah, I would argue that. Yeah.
All right. What else besides speed?
Less documentation, smoother process.
Less documentation.
Higher touch, higher understanding, limited barriers to entry, limited obstacles compared to a bank in a highly regulated environment that needs a ton of documentation.
So not just a credit score.
No, just any documentation, right, that a bank would require. 2 forms of repayment is often required by banks and things of that nature. So a private lender can look at an asset, understand that risk, and arguably be in a much better risk position with a higher yield and get to the table much more quickly than a bank. And those are great things. I mean, consumer pays a bit more, but has a smoother process.
Yeah, so let's stay with the theme of the cost of this entry of private credit. And I think that one of the unintended consequences is that there's this new avenue of capital, the private credit markets, but on average, what would you say the increased cost to the borrower is of this capital, if you were to
Let's
put
say
the number?
minimum 2%, minimum
Yeah.
2%, and it could go much higher than that. Yeah,
Yeah, I've always said, at least for the last dozen years as I've been talking about this topic, it's probably somewhere between 2 and 5%.
right. Could be higher either, but yeah,
Could be high.
minimum 2%. Yeah,
But yet,
fees are higher generally too in these situations.
what is the borrower, because this has exploded? The rationale is the borrower is saying, "That's it. I've had enough of this barrier of entry to borrow money. I need a solution. I need it now. I want to
That's
use it."
exactly right. Yeah.
It's
A lot
pretty
of cases,
crazy.
if you have a business, 2% on interest rate isn't going to move the needle, but having another amount of capital that you can use to fund your inventory or buy a property is really, really accretive to the business. So just the access to capital is huge.
Yeah, so let's look at a few of the historical events that took place. I think we talked about 2008, that regulations pushed banks out of riskier lending. Banks pulled back in small business loans and real estate development and middle market corporate lending. So private credit stepped in.
Mm-hmm.
On the other side, though, let's talk about the investors. The investors saw this like us. I mean,
Huge. Yeah.
we can't get into the different funds that we run and the different
Right.
strategies here on this because of that regulation. But for us, we jumped in because, and we tell this story. I mean, one of the whole reasons one of our companies was formed in 2013 was because the people that were borrowing from us at the bank level prior to 2008 couldn't get access to capital. All of a sudden they said, "Hey, we'll give you a big premium. If you'll lend us the money, we'll give you a big premium."
Yeah.
So yield
Yep.
attracted all this
For sure.
this investor base.
And duration, right? You have shorter durations typically, so you can get a higher yield, shorter duration with less risk. What's not to love from an investor perspective?
Sounds like you and I really love private
Yeah,
credit.
we do. We sure do. And what's funny is the banks are now lending to the private lenders, right? So,
Yeah.
so that's an interesting aspect of this as well.
Yeah. So what else can we share with our viewers and listeners here on, just educating them on private credit? I'm kind of looking at my notes here to see if there's any other argument here, but you and I share in previous episodes about how we use leverage, which is cheaper debt
Right.
that we borrow
Right.
to provide private credit to our borrowers,
Right.
and how we arbitrage and use leverage.
For sure.
So not only is it cool that we can get a premium for our own capital because of this great opportunity, but now we have strategies that can even drive yield.
Yeah, for sure. And I think for the borrowers, it's all about efficiency, right? Whether that's I'm not going to spend 20 hours trying to chase after these banks to get my loan done. I'm going to spend 1 to 2 hours and know that my capital is coming and make real plans based on that capital infusion. I think it's a lot of it's got to be efficiency for the folks coming to us, or frustration, right? I mean, they've tried 3, 4 different banks. They've gotten the runaround for 6 months, 8 months, 10 months. I know a number of people, and I'm one of these people, right? That looks at banks really skeptically, even when a bank issues a term sheet or an LOI and says, "Hey, here's your interest rate. This is what we need." You'll find in certain cases that the bank just can't come through, right? And it depends on the quality of the individual that you're working with, the knowledge that individual possesses, the rank, within the bank, and the other thing would just be the appetite of the bank in the given month that you're applying for that loan. So super inefficient process. You can go to a much more efficient process, and I think going with a lender that has the acumen and understands your business. Once you find a lender like that, you just continue to use them over and over and over again, because you might use bank X 1 month and 6 months later think bank X is amazing, go and apply for a similar loan, and that bank has stopped, producing that type of lending, or the team is gone. And so you just don't find that in private credit, at least in my experience.
Let's take 5 minutes, because I think it's going to take at least 5, maybe even 7 or 8. And let's dig in a little bit more on the nuanced difference of underwriting. And in one of our courses in the Wealth Creators Institute, when we talk about banks and underwriting, we get into this in great detail.
Mhm.
We only have to cover 5 or 7 minutes, but banks have to underwrite. I'll start us off to say that banks have to underwrite to really know risk. And there's 2 risks that they're focused on for the most part. One is the risk that the borrower unequivocally has and will repay that loan each month, so payment risk. And 2, that the underlying collateral, if there is any, will protect them if the payment risk falters.
Right.
Which means that they're underwriting tax returns,
Right.
bank statements,
Right.
financial statements,
Right.
credit reports, and they're unequivocally making sure that you've got a historical, documented way to support through tax returns that loan can be made. So the bank is underwriting to no risk whatsoever.
Right. And often with a team that's less qualified, right, than some of the private credit folks, right? Because your private credit folks that are backed by individuals and companies that are in that space to be in that space, right? Generally, at a bank, you're dealing with some local resource potentially, or some resource that's at a call center, or some processor that has 100 files, 200 files. And I've even been with private banks, which well, we could talk about at some point, right? Explaining the difference between a private bank and a non-private bank, but banks that cater to individuals with much larger relationships. And I personally have experienced in a bank where I may have a ton of deposits in that bank, and I may have a long-standing relationship in that bank. And literally, I will sit there on the phone with many underwriters, and they will say, Alex, we understand that you make enough money to qualify for this loan. We're just trying to figure out how to document it, right? And my response is, well, just to be clear, you guys have all of my bank accounts. You see all the money that goes in and out, and there's a document in your possession known as a tax return. And that's what the government utilizes to determine what I actually earn, right? I would flip to that document and maybe utilize that document. And what's funny is, in that case, I think I was maybe 60 days into the application process. And so I was just like, oh, forget it. I applied somewhere else and closed the loan before they even figured out whether or not they could approve the loan, right?
Yeah.
And so you're dealing with a really substantial underwriting process, and with folks that have limited experience and understanding of the various documents that they're required to put together to properly document a loan. And so you have a series of roadblocks, right, that you have to go through, and a team that's navigating those roadblocks that generally doesn't have the right set of experience to navigate those properly. And so they're relying on third-party information. It may fit a checkbox, but a private lender may look at something and say, this doesn't make sense, where a bank would just say, okay, that's a checkbox, boom, I'm checked, now I'm moving on to another thing. And that's partially why banks have portfolio issues, right? Because they may not realize an appraisal doesn't make sense, right? To the bad or to the good for them. They may not understand the nuances of the tax returns and the economic situation, whereas a private lender can really look critically at these things and often manage the risk a lot better with higher yield. So what's not to love about it?
Yeah, great detail. Love that. We could probably, you and I, sit here
for hours about this. Yeah,
because we are involved in a lot of businesses,
right?
And we have probably a more complicated financial profile than maybe others. And I think, to your point, I have found that I finally just say to the underwriter at some of these banks, let's just call it a day.
Exactly.
You don't.
Yeah, why waste time? Yeah.
You're clearly using a checklist,
Right.
But if you don't understand business, you don't understand self-employment, and you
Right.
don't understand.
They don't even understand the documentation that's required to form a business generally, right? And so I'll get all sorts of questions about what is this, and I have to explain to the banks, well, this is related to this type of company, and let me explain how that is. And once you realize you have to explain to the people what the actual documentation means, it doesn't give you a sense of comfort over whether or not you're going to get that loan.
That reminds me of a story I need to tell.
Yeah, you should.
I'm going to tell this story.
Yeah.
It's a short story.
Perfect.
But it illustrates. I was 19, less than 1 year in the loan business.
Probably 70 years ago?
70 years.
Yeah, it was a long time. Yeah.
Thank you, Alex.
Okay, cool.
I appreciate
No
that.
problem.
About 70 years.
Yeah, but probably a long time. Yeah.
And I was in the mortgage lending business and real estate business for less than 1 year. Really didn't know what I was doing yet. I mean, I was learning.
Like any 19-year-old getting into a business, right? Yeah, learning fast.
And I remember I got a call, and back then I did both private credit and also regular loans at banks.
Right.
And I got a call for a guy that wanted to borrow money on a really big house, one of the largest houses I'd been to at that time. And I pulled up to this guy's massive house, and his butler answers the door, escorts me into the library.
Or lounge of some type. Yeah, nice.
And I wait for this guy, and this 60-year-old distinguished-looking man comes out. He has
smoking jacket, probably.
Stack of tax returns with him, because I had taken the application early.
Right.
And I was going out there to collect documents. And he hands me this stack. And he's just staring at me. And I'm looking at the documents, pretending like I had any clue what they said. And this guy was a good old boy from the South, even though this was in Maryland. He goes, "Son, let me ask you a question. Do you have the faintest idea what you're looking at?" What do you think I said?
That is a great question. I suspect that you may say that you don't have a clue about what you're looking at.
That's exactly right.
Because you're so honest, yeah.
Yeah. I said, "Well, sir, the truth is, no, don't have a clue how to read this 1-inch thick tax return.
Right.
But you can bet your ass by the end of the week, I will."
Wow.
Yeah.
That's a great response.
So,
I like that.
So I got in my car.
How did he respond to them?
Pretty good.
Yeah.
Yeah. So I got in my car. Okay. Now back then, no cell phones.
Right.
So I didn't get in my car and make a phone call.
Right. Yeah.
Got in my car, drove home, drove to the office. Who was my first phone call that I made the second I walked in that office?
I would imagine a mentor of yours at the time.
I called the only accountant I knew.
Yeah.
And I said,
you called the accountant. Okay. That makes sense.
And I said, "Hey, I got to come over to see you right away." He's like, "Well, I'm busy." I know, "I got to come over and see you right away." I said, "I need an hour of your time."
That's great.
And I took the stack of documents over to the guy's office, and I said, "I'm not leaving this office till you teach me every single line on this tax return."
Wow.
Yeah.
Did he?
Yeah.
Wow. Good for you.
Yeah.
That's
anyway,
great.
So I tell this because
unfortunately banks can't do that.
Imagine I work for a bank, right?
Right.
Now I'm supposed to be trained, obviously.
For sure.
The point is that I don't think banks really take the time to understand how people.
They've got so many employees; they can only train so much, and their employees are pretty transient, right? Most of the employees in the branches don't even understand basic, business documents.
Yeah.
Let alone a tax return. I mean, they really don't. So.
Yeah. So private credit for you and me has been kind of the staple of what we like to do. We talked about in a previous episode, money never sleeps.
Mm-hmm.
So the reason we like it as an investor is that we're lending money. Now we for full disclosure, we generally only lend money secured by assets.
Mm-hmm.
So we're not doing unsecured private credit.
Right.
We want full collateral.
Right.
All right. So anything else you can think of that our audience would benefit from in understanding private credit before we wrap up this episode?
I think private credit, all I would say is I think private credit just becomes more and more advanced over time and a larger portion of our economy, just given where regulations have gone. And there may be some regulatory changes at some point that mitigate that to an extent, but I just don't see private credit going away. I see it expanding. Would you agree with that?
Yeah, I don't, for sure, I don't see it going away. It's been too profitable. And, if you look at the statistics of some of the private credit providers and how well they've performed over the last 10 years, even though we've had a great economy for many of the years, the private credit providers have done very well.
Yeah, and only better as interest rates have risen, right? So
Yeah.
it's a pretty amazing thing. And what's nice about private credit, we teach this in some of the seminars that you've done, is that you effectively get to act like a bank in a much, much more efficient way with less risk and a higher yield in a lot of cases.
Yeah, well said. And I think that's a great segue into let's plug the Wealth Creators Institute. So if you want to learn more, contact us at thewealthcreatorsinstitute.com and be part of our community. And we do have courses and lessons, some of it free, some of it not free, to learn about private credit. Now, private credit, just for the sake of this discussion, we can explain to our viewers and listeners that private credit, you can do it for a living and originate private credit and make fees,
Mhm.
right? Commissions,
Right. Yeah.
and work for a private credit provider like us.
Right.
Or you could be I don't want to say a wealthy investor, but you could be an investor that qualifies, that has capital,
Right.
that wants to learn how to deploy their own capital safely. And again, let's plug the book here, Be the Bank.
Be the bank. That's exactly
Be the bank.
Yeah.
So if an individual wants to learn to invest their own money, they can read this book. Or they can just contact us and we can act as their mentor and provide guidance to them.
for sure.
Yeah. All right. So I guess with that, Alex, we'll say goodbye, right?
Thanks, everybody.
But it's not forever. It's only for this
So
episode.
don't have to cry.
All right. Don't cry.
Yeah, that's right.
Yeah, I know. I'll be sad. But anyway, thanks for being with us in this episode of From Worry to Wealth podcast, and we'll see you in the next episode.